In this video, we're going to talk about a brief guide to futures contracts. Stay tuned. Hey traders, a very warm welcome to you. Okay, so most of us trade via a CFD, a spread bet, or something similar. But if we're trading directly on an exchange, most of the time we're going to be trading the futures contract. These are a centralized exchange run by, whether it's in America or Europe, a centralized venue where people can transact futures contracts. Let's talk about what a futures contract is, what we can trade, and some of the kind of anomalies of futures contracts. So a futures contract, we can trade currencies via a futures contract. We'll talk about more why we want to do that in a moment. Commodities, like soft commodities, like we could have anything from cotton to cocoa to soybeans, I mean agriculturals as well. We've got meats like lean hogs, anything like that we can trade in futures contract. Indices, we've got stock indices like Dow, DAX, S&P 500, NASDAQ, Russell, CAC, whatever list goes on. Talks about agriculturals, coffee, sugar, that kind of stuff, oil, natural gas, crude oil, two different types of oil, gold, we've got metals like silver, gold, platinum, all that kind of stuff. You get the point. We can trade pretty much anything. Orange juice, loads of stuff we can trade via a futures contract. So why would we trade a futures contract? What's the point of it? How's it work it out? So basically, futures derive their price from an underlying asset. So the underlying asset is going to be the stock index. That's the Dow index. It could be the FX, the FX pair value at that moment in time, the value of gold, the value of oil, whatever it may be. It derives its price from the underlying asset that it's priced on. So then we have an expiration date. And this is why they're called futures, because really we have a time when this contract will expire. And simply put, if I were to transact with you and I was to buy one futures contract and you were to sell one futures contract, if we held it to expiry, what that is basically saying is I'm buying that contract. You're going to deliver me the contract value of that product at the end of expiry. That's very simply what would happen if we held it to expiry. So if I were to buy one futures contract of crude oil, which I believe is 1,000 barrels, it may not be. I haven't traded crude oil for a while on the actual exchange. I would buy one futures contract, let's say it's set to expire at the end of June of this year. I would have that futures contract. When it came to expiry, you would deliver me 1,000 barrels of oil and I would pay you the value of that contract that I purchased it at. Now, the interesting point here is that it's the price that we transacted the contract at. So I am hoping that the value of crude oil rises because I'm getting it at my fixed price, and you're selling it because you're hoping that the value of crude oil is going to fall. Now, obviously, if it rises, you're going to have to give it at a higher price and you're going to lose money. Technically, you could lose money. Obviously, it depends if you're a producer of crude oil and you want to lock in that price. This is ultimately why futures were invented. You're a producer of crude oil, you want to lock in that price. You sell your futures contracts for delivery when you know that they're going to be out of the ground or whatever it may be. You've locked in that price that you can sort out your balance sheet. If you're a consumer of crude oil, let's say you're a refinery and you're cracking it and sending off into different kind of petrol products or whatever it may be, you say, actually, I'd like to buy my futures contracts at this price because I've got customers who are prepared to pay this price for their fuel, whatever it may be. It's a commercial decision. So that's really how futures contracts came about, with farmers as well getting a guaranteed price for their produce, not having to wait and see what they might get on the day of harvest, on the day of sale. Lock in, knowing they're going to have a certain amount of yield, transact that correct amount of futures contracts, and then they're there and they just give that and exchange that back for the futures contract. That's really how it all works. But obviously, as traders, we're not interested in getting expiry, and be careful of that. Most brokers now won't let you do that. If you're trading a futures contract, they're going to close it out for you before expiry, before delivery, because the last thing you want is to buy crude oil, it expires, it doesn't roll over to the next one, and you're going to get 10,000 barrels of crude oil on your driveway. Extreme, but you've got to be careful. Most brokers now will not allow you to do that unless it's a specific broker and they know that you actually do want delivery of the crude oil. And by the way, I don't think they deliver it to your drive. I think you have to go to Cushing, is it? I don't know. Someone put in the comment section below where you go to actually pick up your crude oil. There's a transactional point somewhere. Anyway, nothing to do with trading. Expiration date. So stock indexes are quarterly. the expiration date on those. You can trade those for every quarter expiry, and things like oil are every month. So every month they'll change the expiry date. And most volume is what's called on the front month. So as traders, we're looking to transact in the front month. Now, obviously, if we are looking to take a position for a longer period of time, we might take a far dated future several months ahead, several quarters ahead. There's going to be less liquidity in there, because the more liquidity on the front month is because we've got day traders involved, we've got speculators involved, we've got guys like you and I who are trading in and out over a period of days, weeks, hours, or whatever. So there's lots of volume going back and forth. We've got arbitrage players arbing the futures against the stock index, basket of stock indices. We've got guys who are trading spreads, who are like buying the front month, selling the far month contracts, all that kind of stuff. There's lots of obviously different strategies that people employ with futures, but that's going to be where the volume is. And then it will what's called roll over, and the volume will roll over to the next one as this front month comes close to expiry. So the last kind of week normally, volume moves over to the next month or the next quarter, the next expiry date, and then that one will eventually expire and will be delivered out accordingly. So how do we sort of see what we're trading? We've got three components really when we're looking at a futures quote price. We've got root is S&P 500, U is the letter for September, year is 2017, so it's ESU7. ES could be, obviously we could be trading anything there. We could be trading crude oil, which is CL, could be trading Dow, which is YM, could be trading anything. That's the whole point. We're bolting in the underlying asset and then the expiry in the year. So everyone knows when they're trading that on the exchange, they plug it into their platform exchange and see the market depth or whatever they do. They'll know that's the contract they're trading, and they'll know exactly when the expiry is, what the product is, etc. Settlement, there's going to be some settlement rules as to how things are settled. We touched on that earlier in the terms of delivery, and you don't want delivery if you're a trader. They'll all be laid out with the broker and with the exchange. And like I say, protections are in place mostly, but obviously double check if you're going to trade futures that you're not getting settlement. So yeah, just if you're looking to trade, obviously for settlement, you're a business or a company, you want to have to understand how that all works, and that's all exchange level. And then you've got a multiplier. So for ES, you've got 50, and that really means that you're multiplying the value of the futures contract. Let's say it's 2,140 times 50 to get your notional value of the contract. So it's just a multiplier. And then we go off and we look at the initial margin that you need to trade. So initial margin is going to be the amount of margin you have to put up to control that notional value. And that could be something like $5,000, $6,000 for a contract of S&P 500. It's set by the exchange. It's an exchange rule, and you've got to stick to that. If you want to open that, you've got to have that amount in your account. So very, very, very simple. Now, some brokers will kind of give you a day trade margin, and that's their risk they're taking on, and they're kind of doing a little bit of paperwork and whatever to allow you to do that. But ultimately at the exchange level, you have to have initial margin that they set out with the exchange, and these are sort of the kind of criteria with the futures and the features of the futures. So it will be settlement, the multiplier, initial margin, and tick size, and that's how much it will move in increments. So S&P 500 will move in quarters. In other words, when it moves up one price point or down one price point, it has to move up in those increments of 0.25. So for example, 2,140.25, next tick up will be 2,140.5, 0.75, etc. You get the idea. And that's going to be different for each futures contract that you're trading. Advantages of futures, let's put a little plus here. You've got no short restrictions. Generally speaking, you can short whatever you like, unlike kind of having to borrow stock sometimes if you're looking to sell stock short. You've got no day trade rule as well. So in America, you have a patent day trading rule. I believe it's $25,000 needed to trade in a day trade capacity, and there are certain criteria that mean you're a day trader, open and closing a certain number of trades in a 3-day period or something like that. Again, stick it in the comment section below, guys. Leverage as well. So obviously controlling a reasonable amount of a notional value with a relatively small amount of margin. Obviously, it's a double-edged sword. You've got to be careful how using that, but having that facility means you can dial that up or down to suit. So yeah, loads of different reasons why you would want to trade futures, and obviously the main thing is the companies are doing it both sides of the trade. If people are trading FX futures instead of spot, it's because they obviously want to hedge their foreign currency transactions sometime in the future, whether they're receiving perhaps foreign currency that they're planning on receiving, they want to kind of lock in the rate they're getting or they're paying it out, whatever it may be. You can see how people can use these for a commercial reason. And for a trading perspective, we're just using them as a trading vehicle because they're actually tracking the underlying, and they're an easy, convenient, low margin way of trading that underlying asset, which is reasonable high volume and liquidity as well. But obviously, guys, if we're in certain countries that allow it, we can trade spread bet and CFD, which kind of track these things, but give us the benefits that spread bet and CFDs do as a retail trader. Anyway, guys, good trading, keep your risk managed. I'll see you in the next one. Bye-bye.